Today, I'm going to break down 5 timeless lessons from The Intelligent Investor, the book that changed Warren Buffett's life at just 19 years old. Unfortunately, some people think investing is gambling. Others think it's only for the wealthy. And some just assume it's too complicated. But here's the truth. Investing isn't rocket science. In fact, some of the smartest investors in history, like Warren Buffett, have built their fortunes on simple principles. By the end of this video, you'll have a clear roadmap for how to invest safely, intelligently, and profitably in the UK. Lesson number 1, meet Mr. Market. Benjamin Graham introduced us to this character called Mr. Market. Imagine you own a cosy little cafe in Birmingham or Manchester. You've got loyal customers, good coffee, steady profits. Every morning, your neighbour, Mr. Market, shows up with a new offer to buy the cafe. Monday, it's worth 100k. Tuesday, no, the coffee's dead, 50,000 tops. Wednesday, actually, I'll give you 70,000. Would you take him seriously? Of course not. You'd laugh. But this is exactly what happens in the stock market. Share prices move every single day based on fear, greed, and headlines. When the FTSE 100 falls, everyone panics. When it rises, everyone piles in. The reality, businesses like Unilever, Diageo, or AstraZeneca don't change overnight. Here's a UK example. During the March 2020 COVID crash, the FTSE 100 fell over 30%. Did Tesco suddenly stop selling food? No. Did JD Sports lose all of its customers overnight? No. But their share prices collapsed anyway, thanks to Mr. Market's mood swing. Smart investors who stayed calm or even bought more made a fortune when prices actually recovered. The lesson, the market is there to serve you, not instruct you. You don't have to sell just because Mr. Market is panicking. Instead, use his emotions to your advantage. Before we carry on, I want to tell you my intention with this channel. I drive home the importance of investing into assets and help as many people as possible to retire early. So hit the subscribe button and let's build wealth together. Lesson number 2, stop speculating. Here's where most people in the UK get burned. They confuse investing with speculating. Speculating is buying something just because you hope the price will go up. Think of people piling into meme stocks, chasing crypto coins with no utility, or buying shares in companies they've never researched. It's like putting a bet on at Ladbrokes or putting all your hopes and dreams on the lottery. Investing is the opposite. It's calm, thoughtful, and long-term. It's like buying a house to live in. You care about the area, the quality, the schools, the value over decades. Here's the test. If you buy a share of Tesco, would you be happy owning a piece of that business for 10 years, even if the share price didn't move tomorrow? If the answer is no, you're probably speculating. The dot-com bubble in the late 90s is a perfect example. People bought anything with .com in the name, even if the company had no revenue. It ended in disaster. The same happened with the crypto hype in 2021. People in the UK were throwing savings into coins they didn't understand. And when the crash came, many were left with nothing. I've seen this with loads of contractors who put 10k in even amounts like 50k into crypto without any idea of what they were doing. Speculating is gambling. Investing is ownership. And if you treat your ISA or pension like a casino, don't be surprised if the house wins. As always, nothing in this video should be taken as financial advice, and the full disclaimer can be found below in the description. Lesson number 3, margin of safety. We all love a bargain in the UK, whether it's a Boxing Day sale or a cheap flight to Benidorm for a little weekend on the drink. Investing is no different. Benjamin Graham's rule is simple. Never pay full price. Always demand a margin of safety. Think about it like building a bridge. If lorries weigh 10 tons, you don't build the bridge for exactly 10 tons, you build it for 30 tons, just in case. That extra room is your safety margin. Same with stocks. If you think a company is worth £50 a share, don't buy at 50. Wait until it's 30 or 35. That way, even if things go wrong, you've got a little cushion. UK example. During the 2008 financial crisis, Lloyds Banking Group shares collapsed. Many people who had piled in at inflated prices were wiped out, but those who waited until the dust settled and bought strong companies like Diageo or Unilever at a discount made serious long-term returns. And here's the beauty for UK investors. Because we can invest through ISAs and SIPs, we don't pay tax on dividends or capital gains inside those tax wrappers. And that means your margin of safety isn't just about price, it's also about making sure your money grows tax efficiently, tax free. So wait for value, protect yourself, and remember, a great company at the wrong price is still a bad investment. Now, if this little book review has got you thinking you want to start investing so you can build wealth, type yes below and you can join hundreds of other investors in my free community on School. Lesson number 4, defensive or enterprising. Pick a side. Graham says there are 2 types of investors, defensive and enterprising. The defensive investor wants simplicity. You don't want to read annual reports or pick stocks. You just want your money to grow steadily over time. The best approach, low-cost index funds inside a stocks and shares ISA or pension. For example, a Vanguard FTSE Global All-Cap Fund. Set up a direct debit every month, forget about it, and let compounding do its magic. And if you want some options to consider, I'll leave the link for a recent video below in the comments in the description. The enterprising investor is different. Maybe you love analysing business, digging into UK small caps, or researching property investments in Manchester or Liverpool. That's okay. We're all individuals and we'll invest in our own way. But stock picking is like a job. It takes serious time and skill. What you don't want is to float in the middle. That's where people chase hot tips from their mate at work, sell when the market dips and lose confidence. So ask yourself honestly, am I defensive or enterprising? There's no shame in either. But knowing which camp you're in might be the difference between financial success and years of frustration. Now, this is taken from Ben Graham's famous investing book. Personally, I would have to disagree because I invest into individual stocks and index funds. I do a bit of both. What about you? Would you do both or choose one or the other? Let me know in the comments. Lesson number 5, emotional discipline. Here's the hardest part of investing, controlling yourself. When the Bank of England raises interest rates, the headlines scream, UK in recession. Markets wobble and people panic. They sell at the bottom. Then when prices rise again, they buy back in at the top. The result, they lose money while the calm, disciplined investors get richer. Benjamin Graham said it perfectly. The difference between successful investors and broke ones isn't intelligence, it's emotional discipline. So how do you build discipline? By having a system. For UK investors, that could mean setting up a monthly direct debit into your ISA or pension, pound cost averaging, rebalancing your portfolio once a year or maybe twice a year between stocks and bonds, ignoring the daily noise on Sky News, the BBC or social media. Think of it like flying through turbulence. The pilot doesn't yank the controls just because the plane shakes a bit. They trust the system. That's what you need to do with your money, with your investing. The truth is, markets will rise and fall. That's guaranteed. What matters is whether you stay calm, stick to your plan, and let time do the work. Summary. So let's tie this all together. Mr. Market is emotional. Don't let him control your decisions. Stop speculating. Invest in real businesses, not hype. Always demand a margin of safety. Protect your downside. Pick your style, defensive or enterprising, but don't sit in the middle. And most importantly, master your emotions. Discipline beats intelligence. If you put these 5 lessons into practice through ISAs, pensions, or even smart property investing, even crypto, you'll be miles ahead of the average UK saver who leaves their money sitting in a bank, earning 3% or worse in cash. So here's my question for you. Are you defensive or enterprising? Comment below and let me know. And if you found this little breakdown, this book review helpful, hit the like button, subscribe, and share this video with someone who might need to start investing the smart way. Because remember, investing isn't about getting rich overnight, it's about building wealth step by step. So one day your money works harder than you do yourself. Now, if you're serious about building wealth, see below for a recent video that goes into how you can become a millionaire from investing. And it's much simpler than you probably think. Thanks for watching.